Hey everyone, how's it going? I wanted to make a quick video on the option Greeks for beginning people or just people curious. Um, and just the main two that I use, Delta and Theta, the two most important that we're going to need to know for doing any type of option investing. The rest I'm not going to really talk about. It'd be more for way advanced people or hedging and things like that as far as your Vegas and your Gammas go. The main two I want to stick to is Delta and Theta. So I'm not going to get into intrinsic, extrinsic value. It's simple enough, you can read up on that. But what actually makes up an option price? And so you have inputs. The input to make up, like when when a call option is worth $5, what is actually saying that's $5? So and what can make that fluctuate. So the stock price is one input, time is another. How far away is this option? How close is it? And volatility. Volatility is looking out 30 days and it's saying how big of a move, without getting into the standard deviation stuff like that, I know, but how big of a move in the next 30 days is a stock going to make, up or down? So the higher the volatility, the market is pricing in more drastic swings up and down. Those are the only inputs. All the Greeks are outputs. When any of the inputs change, the Greeks will change. None of the Greeks are inputs. And the only tool that the market has to adjust an options price is through implied volatility, which would be this. That's the only thing. So because they can't, let's say they can't control the stock and they can't control the time, and they want to change an options price because they think it's too expensive or too cheap. So you would do it by dropping the volatility. Will drop from, say, 25% to 23%, and that will then change the option price. So that's how it's done. Then I'm going to run through these real quick, and then we'll go over some examples. So delta is the rate of change compared to the stock price. So, for example, we have here this January 12. I just have up on the screen. And the 340 calls, they have a delta of 51, or sometimes on different, you'll see 51%. It won't be 0.51. So this means in the stock, a stock has 100 delta. It always is. So in comparison to the stock, this will move, when Apple moves $1, this will move 51 cents. And again, going back to your inputs and outputs, once one of the inputs change, this output has to change. And one of those would be stock price. So if Apple changes, then this will change. And the deeper this goes into the money, the more you can see it'll go with the stock. It'll start trading closer to 1-for-1. An option can never be 100 delta unless it is it can never be 100 delta. And so that is delta when you're looking for, if you're trying to figure out if you were to buy an option, what do you want? If you want to do stock replacement and you want to track the stock, then you're going to have to come down here. If you don't want to and you want more leverage, then come up here and just know that this will change 25 cents, this price, per dollar move. There's other things that these other Greeks come into play, but at this date and time, that's what will happen. Let's go back to this. So theta, this is the big thing why we want to sell options, is because we want this time decay. As you can see here, let's say, for example, we were selling some July covered calls against our position. and we were selling the July 345s, for example. Every single day that goes by with everything held constant, because again, these will all change as an input changes. But as it stands now, for every single day that goes by, if Apple stays here at 331.95 for the next 6 weeks, every single day 10 cents will be lost. And on a percentage basis, this is a hefty amount. And what happens on weekends is during over the weekend, options have to price in this decay. So what happens is come that Friday, normally you'll start to see about 11 o'clock Pacific time, you'll start to see this time decay really start to kick in for the weekend, because every single day only 10 cents needs to get taken out. On Fridays, 30 cents needs to get taken out, because you got to take out your Friday 10 cents, you have to take out your Saturday and your Sunday. So that's why these will just collapse on Fridays. Or again, like I said, what they need to do, the market has to price weekends in. And so they, with the stock here, they can't just move the stock up and down. They can't magically make the weekend come. So going back to this, the only tool the market has to adjust options prices, so for the weekend, is through implied volatility. So what they will do is they will take, let me do this. Let me change this gamma to a implied volatility. Okay, where were we at that? 345? So what they will do is say this is normal at 20.5, and then the weekend comes, this will get knocked down to 20% or 19% or 18%, whatever it may be. And if there's a long weekend, this will get kicked down even further, because that's the only way that they can make this number drop without this changing. And so that's why you'll have on the VIX, the VIX index, that's why you'll see it on Fridays normally always be down, even if the market gained in volatility, or prices, up or down, it'll still come down because they have to price in that time. So that's the only way they can do it. What else do we have on here? Real quick while I'm on it, this is a good website. This is iVolatility.com for calculators and whatnot. Here is a volatility chart of what it looks like. This blue is historical 30-day. The gold is implied volatility, or looking forward 30 days. So right here, this blue line was what happened, what was realized the past 30 days. And this right here at that time was looking forward to 30 days. So this is why we want to sell options too, because you're selling at this date and time when the only thing that happened in the past 30 days was this. So the market priced this in, and this is all that happened. Of course, this goes forward 30, this goes back, but we'll just use this. So again, people sold options with the premium saying, oh man, Apple is going to move, up at this 30% level. Again, that's not how, it's not saying Apple's going to move 30%, but we'll say at this level. And then what happened? It didn't move at all, the volatility. It collapsed. So you sold it here, and it went to nothing. So you could have bought it back down here. For the most part, as you can see, implied volatility always overestimates. It never underestimates. And so that's why you want to be an option seller too, because option seller always have the edge. Look at all this cushion you have. If you sold up here, it's just an enormous amount. So